understand what is the difference between hedge fund and mutual fund. Now, you have got a basic understanding of what hedge funds are, how they operate, what are the legislation that governs them, what doesn't governs them, how the hedge fund is operated, who are the investors, what is the structure. So let's try to now understand how they differ from mutual fund. The first thing obviously comes is investors. Now you all are aware in mutual fund anybody can invest. So whereas in hedge fund you need to pass the rule as we were discussing above, that is the income and the wealth test, to become eligible to invest in hedge funds. Now in terms of regulation, there are not much regulations which are to be followed by a hedge fund. There are not particular laws which need to be followed, but yes, the law of land has to be strictly followed. But in terms of mutual fund, apart from the law of land, they have very strict regulation which has to be followed, and the mutual fund managers cannot deviate from the regulations or the rules laid down by Securities Exchange Commission. Now flexibility. Mutual fund doesn't have much flexibility. So when it comes to investment, they have to follow the rules and regulation which have been laid down. But when it comes to hedge fund, they can sell short, use derivatives and leverage to ensure absolute returns for their fund. Also, they can invest in any weird things, as we had mentioned and discussed about in earlier slides, such as buying the water rights in Australia, or maybe investing in Brazilian rainforest. So their investments can be as weird as something like a Brazilian rainforest, or as speculative as it can be. But then mutual fund doesn't have that flexibility. In terms of paperwork, hedge funds are privately placed, whereas mutual funds are offered to public through prospectus. So issue of prospectus is mandatory in mutual fund, but hedge fund does a private place. Liquidity, you don't have liquidity in hedge funds. What I mean to say is there is a lock-in provision available. So if you invest today in a hedge fund, chances are that you won't be able to withdraw your money till the lock-in period is satisfied, which is mostly from 2 to 3 years, and it always depends on the kind of investment strategy which has been used, and would depend on kind of investment strategy which has been used, and also the kind of fund which has been in which you are investing. So if you're going in for a simple plain or long short, maybe the lock-in provision would be just few months. But in case if you're going for distressed security assets or any kind of complex fund, the lock-in period would be more than 2 to 3 years. So but in mutual fund this is not the case. So if I invest in mutual fund today, I can withdraw the very next day. So there is a daily liquidity available in mutual fund. In terms of returns, it is always mutual funds provide you a relative return. The relative return is to the index to which they are benchmarked. So suppose if the mutual fund is operating in US, it would be they are benchmarked to Dow Jones. So then the returns would be relative to the performance of Dow Jones, whereas hedge funds doesn't provide relative returns. They believe in absolute returns. So irrespective of the performance of the index to which they are benchmarked, their returns are absolute, and this is because they have the privilege of using derivatives. They can sell short and they also can leverage. That is the reason they have in a position to provide you absolute returns compared to a mutual fund who depends on relative returns. In mutual funds, we do not require any kind of self investment. So basically, it is not compulsory that a mutual funds should have some kind of self investment by the manager, but in hedge funds it is actually necessary, and it is considered good if the hedge fund manager himself invests in particular fund. Now in terms of asset, the mutual fund cannot invest in risky asset class. The reason being because they are generally dealing with a huge amount of population, and hence riskier asset class would increase the risk. And to avoid this, Security and Exchange Commission have laid down rules which prohibits them from investing in any risky asset class. Hedge funds are not bound by these regulations or lesser number of investors, and hence they can invest in anything. as we had mentioned, it can be anything on this earth which can be used as an investment to earn return by hedge fund. In who can invest in mutual funds? Can be anybody having the money can invest in mutual funds. Can be from a small time peon or a office boy working to a HNI who can invest in mutual fund. But in hedge fund, you have to be that sophisticated investor to invest, and also you need to pass the test. What was the test? Income test and wealth test. And also, if you are an institution, then you need to have more than 5 million of net worth in holding as of today to invest for a hedge fund. In short, if I have to summarize, the course try to give you a brief understanding about what hedge funds are, how they evolved, so what is the history behind them, and how they have developed or grown over the years, what is the current industry in terms of assets, in terms of number of hedge funds which are operating, and how the strategies have changed, how the focus have changed. Also, we try to make you understand the legislation which govern this hedge funds over the world, and also how the regulatory reportings are changing because of the financial crisis which we have faced in past.